gotta leave your money behind you. Raise your hand to...
Welcome back to another episode of Gimme Some Truth International, Dame la Verdad, so on and so forth. I'm Keith Ponywaz, joined by my colleague Stan Farmer. Stan, happy to be back in the hosting chair. I heard you took over the hosting duties and Nate took over the hosting duties, and that our public was clamoring for my return.
Yes, people were starting to fear the worst, Keith. So welcome back.
Yeah,
and don't forget out there, if you've missed Keith and you want more Keith, make sure you subscribe to the channel and smash that like button.
I'm just so happy that you were able to get that in early, and I'm hoping for a return
early
of
and
that.
often.
Yep, and hoping to get that
subscribe.
late. So we're back with a little bit more serious topic. We're moving into August, which we know generally in Europe is more of a vacation month. So we have planned some more what we'll call beachy topics or mountain topics that you can listen to. But we did have a kind of more serious topic that we haven't addressed on the podcast. We do have some information about it on the website and so on and so forth. But what we wanted to talk about today were PFICs. Stan, what does PFIC or PFIC stand for?
Well, a PFIC is a passive foreign investment company. It is a really important subject, and something that I think that since, when you first cut your teeth as an expat advisor, you're obsessed with the rule and understanding the rule, because you quickly find out that it's the number, really, other than not filing U.S. taxes, the number one mistake that U.S. citizens abroad make that causes real, not just financial headaches, but tax nightmares.
Yeah, and historically, there are a number of factors that I think contributed to it becoming a problem. The first is PFIC, and a lot of times people attribute it to FATCA in 2008, 2009, but that's not the case, actually. So the PFIC legislation came into effect in the 1980s as part of the big tax overhaul plan. And it's actually something that now may be getting a little bit more relevant. For the last couple of years, may not have been so relevant, but in the late 1970s and early 1980s, when both corporations and governments and everybody had to pay more interest on their bonds, you could buy a bond and get a yield on it somewhere in the 25, 30, 35% range, right? And one of the things that is different about bond interest versus, and a lot of times this has kind of gone under the radar under the last couple of years because bond rates have been floating more around 1 or 2 or even lower percent, is that in the United States, bonds are taxed differently than dividends, right? They're taxed at your income tax rate, right?
Ordinary income tax, marginal tax rate.
Yep, your marginal tax rate. So capital gains, traditionally the number that gets thrown around in the United States is 15%, though it can raise as high as 23.8%. But your ordinary marginal tax rate in the 1980s, even after the Reagan tax cut, was much, much higher, was close to 50%. And so what investors who had a lot of, either U.S. treasuries or corporate bonds would do is they would basically package these together into an offshore holding company, and that offshore holding company would pay them dividends, thereby significantly lowering their tax bill, right?
Right.
And so what happened in the 1980s is they found this kind of loophole, and they put in this rule to contain this kind of tax dodge that people were putting into place.
Right. The idea is, of course, in America, that when you buy a pooled investment, a mutual fund, an exchange-traded fund, a private equity fund, or a hedge fund, but any type of pooled investment, the U.S. tax principle is that if a fund is registered domestically here, it is required to pass on almost to the penny all of the income the underlying assets generate during the year by the end of the year, which is why, in the mutual fund world, you get all of these declared capital gains and declared dividends, usually in December, right?
Yep.
But so the problem that the IRS perceived was, hey, there are people out there that have, there are jurisdictions out there, not necessarily just the Caymans, but there's lots of jurisdictions out there where you can invest and the fund will accumulate dividends. And the IRS saw this as an inappropriate deferral of the income.
Well, even if you're holding bonds in that and you're paying them out, but you're paying it out as a dividend from that corporation, even if you just pay the dividend tax rate, right, you're making 20, 30, 40% savings on those bond payouts. Yes, and further, you can hold the dividend, the interest rate payments in the corporation and never pay it out.
Right.
Which led to basically, and this is, I think, the situation that expats often find themselves in, is we end up in a world of unintended consequences, right?
Yes.
And so the unintended consequence of this was essentially any foreign mutual fund, ETF, anything like that you held, became, with the passage of this law, technically a PFIC.
Right. Even if there was no impermissible deferral of income.
Yep. Even if you were in Spain and buying, a big Spanish, the equivalent of the S&P 500 index fund or mutual fund in Spain, and we see it now today with Vanguard funds. They have the exact same fund, EU registered, EU fund.
Yes.
Holds 500 companies, pays out all the dividends, but is treated like a PFIC.
Clones of U.S. registered funds exist out there and are some of the most popular and most traded funds on foreign exchanges, such as the Singapore market, the Hong Kong market, London, Frankfurt.
Yep.
You could go on and on. But they're the same thing. They pass on their income. Many of them do. They don't all, right?
Yeah.
But most of them pass out their income annually to shareholders, just as they would be required to if they were the U.S. registered variant. But there's a huge, huge, huge difference for investors that are U.S. taxable.
What's that difference? What does that kind of come down to in terms of tax and prep and all of that?
Sure. Well, so if you own PFICs, passive foreign investment companies that satisfy either part of a two-part income or asset test and qualify as a PFIC.
And what is that two-part? So they put in these rules, and what were the rules to qualify something?
So obviously the company has to be foreign, right, or to meet the F. And then to meet the passive, right, the passive investment component of PFIC, it has to there's an income test which says that if 75% or more of the income generated by the company is generated through passive investment, or there's an asset test which says that if over 50% of the company's assets are generating passive income, right? So there's a difference between like a foreign corporation like Siemens that is generating income, it's through active operation. But if, for example, Siemens just decided to halt all operations and just start buying stocks, right? At some point in time, once that either of those, either the income test or the asset test, started, cross those two thresholds, one of them, it just has to cross one, fail either of those and you're a PFIC, right? So if a company becomes more of a holding company and is truly passive, other than, having an active role in the management of the active generation of income, it can be a PFIC. So there are even companies out there in the world, not just funds, but there's actually companies that you can buy on exchanges that technically are PFICs as well.
Yep. And so that's really important, because I think one thing people should keep in mind is if you're a small business owner and you have, some assets sitting in the bank or whatever, and you put them in a CD, it doesn't mean your company is going to become a PFIC, but you need to be careful.
Yes.
You don't want, your income from those assets all of a sudden to dwarf the income from the other things you're doing. That 50% rule can be a little tricky because, if you don't have a lot of physical assets, you want to be careful. Obviously there are intellectual property assets and all of that, but it can mean as a small business, you have to be careful.
Right. But just for everybody out there listening, that has, moved abroad or chosen to, maybe even have a second home abroad. Okay. The number one rule is that you cannot go native when it comes to your investments, right? The number one way that these PFIC rules are violated is by people just, listening, making friends abroad or business colleagues and hearing about, well, I park my investments at HSBC Bank and they've got some great tracking funds and, and doing what everyone else in your residence country does, right? Which is invest locally, but investing locally through funds, right? Pooled investments, even money market funds can trigger this.
And I think we saw this a lot more from what we might say is 1990 to, or, post the passage of this law, mid-1980s, to about 2009, where solutions were often pitched just to expats broadly. And
Yes.
we saw this with insurance solutions, certain
Yes.
annuity solutions, so on and so forth, where they were pitched expats, and usually it came with a British accent.
Yes.
Because they spoke your language and they found you, and they would say to you, "Oh, you're an expat. You should you should talk to my guy because he's helping me get out of the local tax
Right.
situation."
There really just aren't many firms. I mean, obviously, our firm, or at least our team within our firm, specializes in helping Americans because Americans are different than other expats. Other expats don't have to worry about the tax rules of their country of origin once they're a resident somewhere else.
Yep.
Americans do. So all of these, British, or it doesn't have to be British, but the British have a huge industry of offshoring your investment wealth once you've left the kingdom, so to speak, right? And a lot of these companies push insurance kind of based investment schemes. They like to use the word scheme. Like in America, that seems to have a different connotation.
Scheme connotates different.
But scheme, just ought to raise the hair on the back of your neck as an American, because like we're not used to people on TV don't say, "Hey, come invest in our scheme," right?
Yeah.
So
what happened
but all
was,
these products are invariably offshore funds, underlying the investment scheme, right?
Yeah, and so what happened is, for a long period of time, it didn't matter, because even though the U.S. had citizenship-based taxation, a lot of Americans, because there was really no method of enforcement, just kind of skated by, maybe never reported these things, never let, or even if they were, reporting it, it wasn't, they weren't filing the FinCEN, or, there were just a number of things that basically made these investments kind of fly under the radar. So people who lived in Spain were investing locally, living in Spain, even though they were Americans. They'd buy these funds, and either they didn't realize they needed to report them, or they reported them and nobody kind of paid attention because the world was very different. There was no real way of looking under the cover,
Right.
and so on and so forth. Well, what happened was, with the passage of FATCA, the Foreign Account Tax Compliance Act, all of a sudden these PFICs became a problem, because one, Americans who hadn't been filing taxes, now all of a sudden there were penalties and more assessment of these foreign tax accounts. The U.S. government was going to find out about these accounts, so even if you had been reporting them or reporting them improperly, or not completely, all of a sudden the U.S. government was going to know about these foreign funds.
That's right. I mean, through technological innovation and through intensively aggressive negotiation, the United States has basically made all foreign financial institutions comply with an act that says that if any of your clients are suspected Americans, you need to report, you need to provide an accounting of their assets and holdings to Uncle Sam, right?
Yep.
And income, right? So as if you were a bank, in Iowa, right?
Yep.
The same rules apply to you. And if you don't, well, we've got the big stick of mandatory 30% withholding on all your interbank transactions, which is a big stick.
So to kind of return to the PFIC question, so Stan, and we started talking about this, and we got into the details.
It's it's a big
PFICs
subject
and how they work. What if I'm an American and I hold a PFIC? What are the tax consequences? Now, one thing
Right.
people should be aware of is there's a de minimis amount of PFICs that you need to hold, right, in order to be worried about them, right?
Actually, that's sort of true. If you don't have any distributions from your PFICs, and your PFIC holdings are below 25,000 in aggregate in any given tax year, or as a single or separate filer, or 50,000 as joint filer, you don't have to go through the tax process that we can get into briefly, right? So you don't have to file separate tax forms for each of your PFIC holdings. You can kind of, skate by. If you've got a distribution, a PFIC form, which is 8621, needs to be filed regarding that particular holding, even if you're below this threshold.
Yeah.
So it's really hard to, you don't want to make too much of that de minimis, because at some point in time,
Yep.
likely you've got a PFIC reporting requirement, and then you're subject to the PFIC tax regimes that may apply as a consequence.
Yeah. So yeah, to be perfectly above board, if you have more than 25 or you're getting distributions from a PFIC, you're going to have to file Form 8621. But one of the other differences too is how gains and so on are taxed,
Yes.
right, on PFICs. And what's the kind of variation there?
Okay, well, there are 3 tax regimes, okay, but if you could only elect a tax regime in year 1. There are 2 alternatives to the default rule. The default rule is essentially this. When you receive a distribution from a PFIC, that distribution will be measured against an average of the 3 prior years to determine whether or not there's been an excess distribution. If there's been an excess distribution, that distribution in excess will be applied to all prior years of your holding period. And guess what? So that means restating your taxes and paying penalties and interest for taxes that you should have paid on income you had not yet received. And just as a mega, screw you bonus, all of your taxes will be paid in the current year and all those previous years on this PFIC income, on that distribution, at the highest then available or applicable marginal tax rate, which is 37% now in the U.S., plus potential ACA charges as well if you trigger the net investment tax, right?
So you can see that 37%, that the way the penalty is set up, right, is to prevent people from not paying out and then paying out.
Yes.
And also holding bonds and paying out at a dividend rate and then going,
yeah, I mean, let's put it this way.
I'm not paying I don't have to pay that ordinary income tax
Yeah,
rate.
I mean, theoretically, you buy an accumulating fund that owns the S&P. You hold it for 20 years. The thing's tripled. Well, I mean, at some point, you're going to sell it. Otherwise, why did you own it in the first place, right? I mean, so eventually, you're going to sell it because it doesn't give distributions.
Yep.
But eventually, you're going to sell it, and guess what? Theoretically, the applicable marginal tax rate that could apply could exceed 100%, right? I mean, because of all of the penalties and interest that you would take over that 20-year holding period, and all of the accounting. Just imagine paying your accountant to fill out forms that the IRS say take 20 hours each to do for each PFIC you own. And then imagine them having to do that and restate taxes and file these forms over the prior 20 years, right? Imagine what that fee might be. So, I mean, it gets really ridiculous, right? So, because it's so patently, obviously, offensive, the default regime, the IRS created the mark-to-market regime, which said, hey, if you could go own a PFIC, it's not illegal, right? There's no crime in this.
Yeah, and that's one thing that's often, misunderstood is people think just the mere act of owning a PFIC is going to get them thrown in jail.
It's not like failure to file an FBAR, which is crime, right? And it's finable, right?
FinCEN 114 now, right? Not the FBAR.
FinCEN 114. Well, I mean, we all still call it the FBAR.
Yeah,
but
it'll always be Burma to me.
But from my time in Rhodesia, we always called it the FBAR.
Yeah.
But no, if you can do this mark-to-market election in the first year of PFIC ownership, which basically says, hey, I'm going to report every year regardless of distribution, and I'm going to pay tax on the appreciation and any distribution received from said investment. Okay, so I'm going to fill out the 8621 each year, and I'm going to pay on the accretion or the appreciation of the PFIC, and I'm going to pay as ordinary income tax at my marginal tax rate, not capital gains rates. You don't get those, okay? So this is a popular way of, there could be some very good reasons out there why an American would be in a situation where they need to own a PFIC, right?
Yep.
I mean, we don't need to get in the weeds on that. But
one big one often that we'll look at is like inheritance. That's a case, right?
Right.
So that, grandma left me these British mutual funds. And
right.
Now I'm, how do I get out of them and how do I pay tax on them?
Right. I mean, you could get into an investment that you find out for whatever reason you can't get out of for a certain period of time, right? If you catch it in the first year that you own it and you report this way, it's not as oppressive, right? It's more like you get to pretend that you're a Dutch taxpayer, because it's kind of the way the Dutch tax, investment gain. You get to pay unrealized gain every year, right? And that affects your basis, and of course that complicates your accounting to no end. Yep. But it's doable. The other alternative regime is known as the qualified electing fund regime. And I think that this is something that, make people really excited when they first read it, but it's something that rarely applies if you just simply own offshore funds and you're kind of, a do-it-yourself guy, or you've got an advisor at a bank that's, putting you in index funds. QEF, qualified electing funds, are essentially saying, hey, if the fund itself provides each U.S. tax resident, American citizen or green card holder, with a tax form that is like equivalent of a 1099, and it has to meet very strict criteria, then the taxpayer could check the QEF box on the 8621, and then they will be treated just as if they were domestic, onshore, passive investments. They will pay. They will even get capital gains treatment on their distributions. Okay, so again, now it sounds great.
Now, in the whole wide world of funds, how many of the PFICs are QEFs?
I'm not sure that I've ever heard of a publicly traded fund getting this treatment. So think more about like some super wealthy elite that are in on some private equity investment, and where there's like every investor's $100 million in or $10 million in, and they can pay the money to hire the accountants and the lawyers to draft this up to make sure that a very detailed conscripted form that meets all of the QEF criteria are provided to each of those American shareholders, right? So you might have an international private equity fund that is so big, but it requires such an investment that they're willing to go through the expense of basically creating U.S. tax records.
If you're investing $100 million, they're going to spend $10,000 on the accounting for you.
Exactly.
Yep. So, and we're bumping up against kind of time here, but I think in the sort of 20, 25 minutes here, I think we've covered very clearly kind of the history of what we're seeing in PFICs. I think it's, as time has gone on, as the FATCA rules, I think we see it less common than we once did in terms of people coming to us with PFICs, but it still happens. And we still get the question, I'm moving to Europe, I want to invest locally, or, so on and so forth. How do I do that? Well, the long answer short is it's very hard to do. And, as well, and one of the things I think we also counsel our clients on is, if you are starting a small business, be very, very careful that you don't inadvertently create a PFIC out of your small business.
Right. Don't use it as a holding company.
Yeah. So don't do that. Make sure you're getting a good accountant. So, I think what we're seeing more is, people who found themselves in this problem, how do they get themselves out? And that's where we're counseling people. But I think it's less, there's been more information. And because it's gotten harder because of the FATCA to open accounts with a local broker or local bank or whatever, it's gotten hard for people to accidentally walk themselves into PFICs.
That's right.
So
it's more likely that a foreign financial institution now will hesitate when they find out that you're American, and they won't hand you the loaded weapon.
Yeah.
So you won't be able to shoot yourself financially quite as easily as you used to be able to because of FATCA.
Yeah. And so
in that sense.
Yeah. And so, it was always wrong or
right.
you never wanted to do it, but FATCA made it so that it became a real problem and an immediate problem or a more immediate problem to have these PFICs. So if you have questions, I think if you're, looking, if you're, a mixed, where we still see it are mixed nationality couples.
Sure.
Place to think about it, how to handle that. And so it's something, you should reach out to us on. If you're, inheriting PFICs, how do you handle them? We're happy to advise on those.
Those Guernsey and Isle of Man and UK-based, expat advisory firms are still out there marketing, and they will not hesitate to market to you. They're not terribly worried about the PFIC rules.
So, while you want to go local from a standpoint of moving, learning the language, all of that, you don't want your investments to go local. So you should reach out if you're an American to us at Walkner Condon International. Stan Sill and I are here to help and advise you on these things, including how to tailor your investments, because one of the things people go, well, I need to invest locally because I'm worried about the currency,
Right.
And why that's not necessarily the case.
And today there are more rules in other countries that encourage you to keep your money there, right?
Yep.
And so we've had to, work hard to make sure that we have investment solutions that work for Americans, that can be somewhat more country-specific because of the limitations that have been put on them by a foreign residence country rules. Right?
So, make sure you reach out to us. We're happy to chat with you on these questions. And Stan, I know you have one more thing to add about smashing and liking and whatever it is you like to say about.
I just said if you like the content of this channel and you want to read more, subscribe to the channel and look back through our information, and feel free to comment and make suggestions on topics that you'd like us to cover. And of course, do smash that like button. We like to get positive feedback on the work that we do here at Walkner Condon.
So I've vowed never to encourage this behavior from Stan, but apparently here I am. So thanks for listening.
Well, unlike the PFIC rules, some rules were meant to be broken, Keith.
And thanks for listening, and look forward to providing you with maybe some lighter content here as we get into August. You can't tell here from the view behind me, but it is hot here and good beach weather as well. So we're thinking of more vacation-esque topics here for August coming up for you. But thanks for listening, and we'll see you next time.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.